Awesome. Now we can see you as well. Welcome, everybody. Thanks for joining us at the Kingsdale Mortgage Center Agent Training. This is our first lender training, so we're really excited about that. Dario's here from RFA. We're really excited to have him. I'll let him introduce himself. He's been in the industry for quite a long time, so lots of knowledge to impart on us. I'm gonna get started just by, I know some of you have not met each other yet, so maybe we'll start. I haven't met a few of you, so maybe I'll just go ahead and go first. My name is Ilona Cozio. I'm the CPO here at Kingsdale Mortgage Center. And I'm here to facilitate some of this stuff and basically help you guys on your journey. So if you have anything that you require, I'm going to share my contact information in the chat. You can reach out to me if you need any support, if you need any guidance, and if you want to get in touch with our mortgage broker, our principal broker, Sang Kim. I'll drop his information in there as well. And if you're not part of our group chat yet, let me know and I'll get you added. So we have a WhatsApp group chat as a resource for you all to ask questions, to chat with each other. If you guys have anything urgent, that's a really good place to share and ask questions. So yeah, that's me. I'm here for you. And yeah, maybe we'll go. Jatinder, you want to go next?
Yeah, sure. So I'm a full-time Dynamics 365 consultant. So Dynamics 365 is a CRM. Actually, I'm a developer. So I'm starting my journey in the mortgage industry with you guys. So this is going to be my first brokerage, and I just recently got licensed. So happy to be here. Yeah.
Awesome. Thanks so much for being here. Dixit, you want to go next?
Yeah. So my name is Dixit Patwal. I'm full-time real estate agent. Now I just got my real mortgage agent license too. So I'm happy to join like new things and development.
All right.
Yeah, so I guess I'm a little slightly different. I'm here more as an observer. I've been in the mortgage industry, I guess, about 7 years, on many different levels, actually, as a funder, evaluator. I have my mortgage license, so I don't really do that many direct client applications. But I was brought in maybe to do some training and mentoring of people. I do marketing and sales, so it's just an extension of what I already do. So I just wanted to thank everybody for being there, and I'm looking forward to hearing from all of you.
Awesome. Thanks, Anna, for being here. We're excited to have you on the team. Is it Faris?
Yes, it is. Yeah, I'm a little different as well. I'm actually an automotive business student, and a family friend recommended me to give this a try. So that's what I'm doing here.
Awesome. Happy to have you. Okay,
Thank you.
Mario, I'm going to hand it off to you. We're excited to have you and learn from you today.
Okay, well, hello everybody, and thank you very much for taking the time to listen to me this morning. So I work with RFA Mortgages. I'm the BDM for your team at RFA. So I'm basically your point of contact when it comes to discussing deals prior to submission. Certainly, I'll help you out with all our programs, and I'll give you a lot of marketing tips. I usually like to do that rather than talk about a product, because you'll find most lenders typically offer the same kind of products. It's just more or less finding the right lenders that can help you and build your business. So my background, I did come from the banking world. As you can see from my gray hair, I have been doing this for many years. So I have a pretty good financial background. I been lending almost for the last 35 years. And so I was in private banking my last 10 years, and I got packaged out, like a lot of guys my age. And so I decided I still want to work. And so I found myself into the mortgage brokerage world here. So I've been doing this now for about 14 years and loving it. This is probably one of the best industries to be in if you like helping clients, and if you like helping clients in a lot of different scenarios. Working with so many people in different backgrounds. I could tell you a lot of mortgage agents, and like yourselves, you all come from many different backgrounds, but I think you'll find this industry to be quite good. And I think you can, do very well on it financially, as long as you stay focused, as long as you know you got to wake up every morning and just be in the right set of mood that this is what you want to do. And I think you'll find that this is going to be a great industry. So so with that, what I'll do is I'll just mention quickly what RFA does, so you can know who we are and what we're all about. So RFA is actually a privately held company. We're about 35 years old. We started in the mortgage brokerage. We started selling commercial or doing commercial mortgages. So we started doing that. Then we also started buying commercial properties, fixing them up, and then reselling them. And that's what they basically did for almost the first 29 years, I would say. Did very well at it. And then fast forward about 7 years ago, the company was actually looking to get into the mortgage brokerage world. They actually wanted to acquire a lender because they had the money to do so. And so nobody was available 7 years ago, but about a year later, Street Capital became available. So RFA, which stands for Realty Financial Advisors, that's the name of our company. We purchased Street Capital outright. We also got their bank license. So we had to go through a lot of regulatory processes. That's all been done. We passed with flying colors. So Fisco and all the regulatory bodies see us as a very good, strong company to be able to help clients. So we also took over the bank license from Street Capital, along with $32 billion worth of mortgages under administration. So I can tell you right now, RFA is a fairly large company. We operate right across Canada, except Quebec. We do both an A and a B program for clients. So that's available. And you'll find us to be, pretty big in the marketplace. We have, just give you from a staffing standpoint, we're about 270 full-time staff members. We have approximately 30 full-time senior underwriters on the A side, but another 15 on the B side. And the rest we have is basically staff. So as I say, we have 3 underwriting centers, one in downtown Toronto, one in Vancouver, and one in Calgary. So big player in the market right now. So we compete against First National, MCAP, all the banks that you see out there. So we are really on the A side right now, looking for your prime A deals. Specifically, we're looking for insured and insurable deals. For any of you, I'm using some lingo here, so I just provide some quick recap on the terminology. So when I say insured, that simply means that the client is paying the insurance premium fee. When I say the word insurable, it simply means that the purchase price of a home or the value of the home might be under $1 million, and we provide you with what's called insurable rates. And there's no insurance premium paid by the client. Okay, so it's simply terminology that we use when we securitize our mortgages, and that's when we securitize to the major capital markets of these financial institutions. That's how we make our money. So that in a nutshell is who we are. You'll find us to have a really good broker portal to help you access your deals, to submit documents into us. Clients have a really good, strong client portal as well, so that they'll be able to view their mortgage. They can make like a lump sum payment in 30 seconds. They can change their payment accounts, all that kind of stuff. I can tell you it's as good as any of the chartered banks that are out there right now. So a very good back-end system. We also have a servicing center that clients can call to make some changes or get information about their mortgage. And for you, we have a broker consent form. So if you are wanting to help your clients on a one-on-one basis for the life of their mortgage, we can give you a consent form to have the client sign. You simply send it in to us, and the center will work with you to get you any information you need about the client. Okay. So that from a support level, technology level, you'll see you got very good support. Any questions before I go into some, maybe a couple of the programs that I did want to talk about that I think are probably going to help you over the next little while coming up. So before I get into that, any questions about RFA? No. You may, I know you probably won't see us in the newspaper because we're not a publicly traded company, but you'll see that when you get to know us and what we do, we offer some very good programs to your clients, and that's why we're really well in the market.
Yeah, so you mentioned that you guys started commercial mortgages, and then you also did some fix and flips, and then eventually you guys bought out Street Capital. So
Yeah.
are you focused the entire business on the mortgage side through Street Capital, or do you also still have the commercial side as well as the development and
Yeah, good question. We actually have 7 different companies, and all these companies do a lot of different things. Mostly, it's all around real estate.
Right.
But I can tell you, like we have our own MIC that we don't put out to the public yet. We still do the commercial developments quite a bit. That's a huge part of our business. We have at the top of the heap, we have our RFA Holdings, which is the parent company. Then we have RFA Bank. We have RFA Mortgage Corporation. We have up to other companies that do a lot of various things. So that's pretty much all I can tell you about RFA. But but at the Mortgage Corporation, I can tell you that's right now, it's like a little baby for us, right? We're a very small component of the overall holdings. And the company is spending a lot of time and effort and money into doing this because we feel that it's a great opportunity for us. And I can tell you when we've pumped a lot of money into the system because we've had to purchase a company. So we purchased Street Capital. So I can tell you that cost us almost $85 million just to do that transaction. And then we had to go through all the regulatory requirements of fulfillment to make sure that, the Department of Financial Institutions was comfortable with our purchase transaction, and they knew that we could take over a company and manage a bank license at the same time. So I can tell you, we are the only monoline lender in Canada that actually has a bank license. It's a Schedule I bank license. So that's a big asset for us, and we're starting to employ it already because we do for our B program, it's all balance sheet lending from the bank side. So it's we fund our own money. We do very well at it. And so when you get access to the B program, we're funding our own money by doing that. Very much like what a MIC would do. Okay. Any questions before I carry on? Okay. Please stop me at any time if I'm using some lingo or some term or describing something that you may not have heard about before in the past, because I want to make sure that you get good information. So one of the first products that I thought I would work with today is collateral transfers, because I can you probably have spoken to a lot of people in the industry in the last little while, and a lot of banks right now have a lot of mortgages coming due next year as well as 2025. So I think for me, if you're having difficulty chasing purchases or helping clients purchase transactions, a lot of people's mortgages are coming due next year, and it's a big opportunity for you to talk to these clients and see if you can help them out with what's called either doing a collateral transfer or a direct switch of that mortgage. Does anybody know what a collateral transfer is? No. Okay. All right. Good. Okay, awesome. Okay, what a collateral transfer is that the current lender that looks after the client has a collateral charge registration over the property. So, for some of you that may have taken the course recently, you probably saw that in the course where they talked about a collateral charge. If any of you, with your bank accounts, if you have your own mortgage, for example, your lender, if it's a bank, may have registered a collateral charge or an umbrella number over the property to secure the money, right? So it's one umbrella charge basically, and underneath that one charge, your client can have a mortgage, they can have a HELOC, they can have a demand loan, they can have a car loan, they can have a good number of different types of products underneath that one charge. The benefit why banks do this, of course, is to give clients a better rate. That's what they say, right? Maybe not. So, but what it does is it ties the client more into that bank, right? So it is a good product that way. There's definitely no qualms about it, but What I'm saying though, if you want to use it as an opportunity for you to acquire some business, a lot of clients will have mortgages coming due. And so as you're talking to a client and they tell you, I have a mortgage and a line of credit with a bank, right? So let's say they call it's with RBC, it could be the home line plan at RBC. That's what it's called. The collateral charge at RBC. Okay, it's called the home line plan. So if they're showing you their statement, right? If you see the words home line plan, then you know automatically it's a collateral charge. Okay. Now, so the next step is clients say to you, my mortgage is coming due, right? And I have the HELOC. Now, the reason why I'm saying it's a great opportunity for you guys, because in the past year, obviously, year and a half, I'm sure maybe some of you personally have been experiencing it, but I can tell you a lot of your clients are experiencing it. And that they've seen their mortgage interest costs go up quite a bit in the past year and a half, right? I mean, look at where prime is today, right? 7.2, they're probably paying like 7.5 or maybe higher on that HELOC. And of course, a lot of them have also got into a variable rate mortgage, which means that their payment has stayed stagnant. And guess what? Their amortization now has increased to about 40 years, 50 years in some cases. So a lot of clients are stressed out about both of those items, right? And so what we can do to help you is that we can help you combine those two products together and transfer it over to us. So if the mortgage is, let's say, coming due on March the 1st, right? You can certainly submit an application now to bring those two together. But basically, what we want to do is take the full balance of that HELOC plus the outstanding balance of the mortgage and put it all into one new mortgage, so they have one payment, one interest rate. Okay, and I'm bringing them down to a much lower rate. So for today, let's say if the loan to value is at 65% or less, you can give the client a rate of 5.64% versus they're probably paying, 7.2 for sure on that HELOC, and they're probably, whatever the rate is on the variable rate. Now, so you're bringing the two together. Now, so I'll give you a little tip here. Some clients, they may have not used all of the HELOC, right, at the time that you're talking to them, and they say to you, I've kept $50,000 available because I've got a very large expense coming up later on in the year, because maybe they're planning a home renovation of some sort, or maybe they're looking at buying a new car, or maybe they're looking at purchasing an investment property or let's say a condo for maybe an adult child that they've got going to university, whatever the purpose is, right? They've got room left over on that HELOC. Or they could have, let's say, some unsecured debt available. So maybe let's say they owe $5,000 on a credit card, maybe a personal loan, what have you. So what you can ask the client to do is draw down on that HELOC if they got that available room, put the money into their checking account and use the money for the home renovation, whatever they want to do down the road, and pay out the unsecured debt. Move it all over into that secured position. Okay. So everybody okay with that so far? Just want to make sure we're good. Okay. So what we're doing is we're simply, it looks like a refinance transaction, but it's not. This is what's called an insurable deal, which means I give you insurable rates. I don't give you what's called uninsurable. The word uninsurable simply means that anything that we put in there. So let's say if you have a client that needs a 30-year AM, or they need to do a refinance transaction, or they're purchasing a property that's over $1 million purchase price, that means automatically they're getting uninsurable rates if you work with the monoline lenders. The banks don't use that terminology of insured, insurable, and uninsurable. But if you're working with monoline lenders like us, like First National, Merrick's, MCAP, you name it, we all use that terminology. We have to, and that's because back in November of 2016, there was a lot of industry changes that happened, and that's why today, you're seeing rate sheets with those words on it. It's because of, back then there was these changes. So with this particular product, what I'm trying to do here is help a client combine debt, get their interest rate down, right, and relieve a lot of stress from them, right? Because I can tell you, your clients are, in the past year and a half, I'm sure have been paying well over $1,000 a month or more, right, because of those increased costs. Yeah, so it's starting to hurt a lot of people, and I'm sure you're hearing in the news about people's concerns about their finances, right? So this is now the result of all those changes. So it was a great product that a lot of mortgage brokers put that client into, let's say, a bank with a mortgage and a HELOC. Unfortunately, none of us could predict where interest rates were going to go. And so now we're seeing, unfortunately, this coming up. Now, so it worked out as a really good product for the clients initially. So now and of course, today it's not because of the situation, but I want you to start working with clients to bring them down into much better, comfortable situation. So what a collateral transfer, as I mentioned, it's like doing a refinance, but it's not. So we use First Canadian Title Insurance, or FCT. FCT is our subsidiary company that we work with. They will process the whole transaction. So basically, once your broker complete, we will ask FCT to now instruct the other lender that we're looking at bringing the other mortgage over to us. So FCT will contact, let's say, RBC. They'll request a payout statement. Once we get the payout statement, FCT prepares documents for your clients to sign. They will then meet with the clients in person. They're simply there to witness their signatures and get identification. They're not there to provide any form of advice. That's for you guys to do, right? Mm-hmm. So because some clients will ask them, right? Do you think I got a good rate, right? I can assure you they got a good rate. It's just, they're not there to provide any advice. They're not allowed to. Okay, they're just there to witness and get ID. So once we get the payout statement, clients meet, they sign, we take it back, we register, and we then advance to pay out the other lender, and then they start one brand new mortgage with us. Okay, now, so when you do these collateral transfers, there is a cost associated with it, right? Any collateral transfer or collateral registration mortgages, those are non-transferable and non-assignable. And you might have read that in your book. So what that means is that they have to be discharged and brought over to us. So FCT will do that. And because of that cost, what we do is we deduct 10 basis points in your commission to pay for that. So that means there are no legal fees to your client. So remember, it looks like a refi. Usually refis, there's legal fees, right? So we've changed the product so that brokers are willing to reduce the income to pay for this. Obviously, you'll get the business out of it, but it's done, and other lenders offer it as well. So we're not the only lender offering it, but not everybody does it, I think, as well as we do. This is actually one of our favorite products. We're very well known for this. So what we do is we'll simply set it up. We deduct the 10 basis points in commission, and there are there's no appraisal required either. Okay, so you can basically tell your client, I'm going to do a refinance for you. It's not going to cost you a dime except the discharge fee from the other lender. That's it. That's actually pretty appealing. Plus, you're bringing them down from from let's say even 7.2 to 5.64 overnight. You don't
need an appraisal?
No.
What's the reason for that?
So what we do is we waive the appraisal because we're also going to ask you for some documents. So the document that we ask you to waive the appraisal is either an old appraisal, if let's say this is a client that you've been working with for a number of years, an MPAC, so you can ask the client to provide you with an MPAC, or an old MLS. And being a realtor, you can probably get access to an old MLS, right? So guys, make sure you know this guy. He's going to help you get an MLS. So the MLS and these other documents, what they do is they provide us with the square footage of the home and the age of the home. That's why we ask for it. So we then plug those numbers into our AVM system. An AVM system, by the way, just to let you know, it's a free automated valuation system that we we put your information into. We don't charge you for it. Some other lenders do, so be careful. Okay, but we don't charge it. Some other lenders will actually charge you about $150 to do this, right? And so because we ask you for that document, we don't charge you for it. And so the property value now goes through the AVM system. We see the value is there, and that's fine. We waive the appraisal. Okay. So now when you do a collateral transfer, another big benefit to your client, they don't have to take advantage of this, but you can mention it to them. Let's say you need a 25-year amortization to qualify the deal, right? The client says to you, I want to keep repaying my mortgage as quickly as possible, but they may have reduced incomes, right? And so as they may not quite qualify under the ratios of 39-44. So you can start the amortization, get it approved at 25 years, and then once the mortgage funds, if the client wants to go back down to a 10-year amortization, no problem, we can do that for them, okay, very quickly. But the idea is you might need it to qualify, or the clients might say, yeah, you know what, our incomes have gone down. I'm concerned about some other upcoming expenses that I have, so I want to start at a 25-year amortization. And of course, with us, if they do find that, as time goes by, that they've got now extra money left over, or their incomes have increased, and you want to now pay down the mortgage quicker, the clients can prepay their mortgage up to 20% per year without penalty. Plus, they can also increase their payment up to 20% per year without penalty. So the pre-privileged payments are quite good. So the idea, like I can tell you, all our products that we sell, guys, we don't have any no frills types of products. And you'll see that most of the time we offer rates that are equal to, or sometimes even better than what some of the no frills products that you might see out there. When I talk about no frills, guys, do you know what I mean by that? Okay. Again, I'm using some lingo here that just over the years, this is what we do. So no frills types of product means that some of the lenders out there, right, they say, here's my rate, looks really good, right? It might be 5.64. And I can tell you I know 2 lenders today that are actually offering 5.64 on this no frills product versus our full featured product, and at the same rate. Okay. So what some of those no frills products will do is, if your client breaks early, they have to pay a fairly high penalty. And I can tell you 2 of them, one of them is going to charge you 2.75%. Another one's going to charge you 2.5% on the outstanding balance. It's pretty expensive, right? So with our full featured product, what that means is you're getting 20/20 annual prepayments. The clients have, various ways of repaying their mortgage, weekly, bi-weekly, accelerate, whatever they want. And the way we calculate our prepayment penalty is basically like the rest of the monoline lenders, where we charge the greater of 3 months interest or the IRD. The interest rate differential is the same method of calculation as the other monoline lenders. It's cheaper than the chartered banks. Yeah. Your client will say, I want to go to a bank. God bless them. But, when they have to break that mortgage, it's going to be a hefty penalty if they do it during the term of the mortgage. I could tell you, I actually had a broker last little while transfer over a mortgage from TD over to us. And everything went super well. A couple of days later, I was talking to the broker. He called me up and said, Derry, I don't know if you know this, but I want to let you know, I transferred the mortgage over. Client paid $17,000 in interest penalty to get out of TD. And he said to me, I did the calculation. Had it gone the other way, had the client left RFA and gone to TD, the interest penalty would have been $7,000. Like, it's a $10,000 difference. So when you see in the news, like, these high interest penalties charged by the banks, they're true. I can tell you, because I don't know if you know this, but the banks add back the discount that they give you onto the penalty. So this is where it becomes really expensive. So as I say, try to do what's best for your client. I mean, if the client insists on going to the bank, sure, I understand it. But if you're looking for alternatives that are much better in the market, like you're getting a same high quality, and plus, don't forget, if you do the deal with an online lender, you're maintaining the deal, you're maintaining the relationship. I guarantee you, if you send it over to any of the chartered banks, you're going to lose that relationship, or the possibility of you losing that relationship all of a sudden jumps up quite a bit, because guess what? The banker is going to try to cross-sell them everything under the sun, right? So you're, the idea is, when you do this business, guys, you're developing a portfolio of clients. These are becoming your clients. Think about it. Do I want to give it to somebody else down the road, or do I want to keep it? Because guess what? And this as a realtor too, right? Once if a person buys a home from you, or you're selling a home on their behalf, they will, next time they have a buy and sell opportunity, they're probably going to contact you, right? So the idea is keep that whole relationship. It's your client. This is your business. And I can tell you a lot of brokers that do this really well, they will do a good up-teen number of deals for that same client, whether it's family or friends, or maybe now you're helping them buy investment properties, what have you, right? It's you can actually help out a client for a good long many years. I actually had a broker call me up yesterday. She said, I'm doing this deal, and I know the family very well. I babysat for them when they had the small kids. Now I'm doing the kids' mortgages. So this is the life cycle of the mortgage client, right? So keep that in mind. But anyway, sorry, I got off track a little bit. So collateral transfers, the big benefits, as I mentioned, 25-year amortization. You're basically no fees to the client to do this. It's a big benefit. A lot of mortgages are coming due next year. So please ask your client to provide you with their mortgage statement. And now some clients, I can tell you, are going to tell you, I don't even know if I have a collateral charge. Like, don't use the word collateral charge with them, because they're not going to understand you, right? So ask them to provide you with any documents that they can from the last time they did that mortgage. And one of the forms that I would ask you to ask them if they have is what's called the charge of a mortgage. You probably saw that in your course, right? So the charge of the mortgage, if you look in the middle section of that page, it's a legal size form, you'll see the words on demand in several boxes. So if you see those two words, on demand, that automatically tells you it's a collateral charge. So now you know how to best now start positioning your conversation with the client. So that collateral charge is it's used by most banks for sure. And especially if you're talking to anybody from the chartered banks, typically it will be a collateral charge. Now, what you can use this product for as well is sometimes you might see two different prime lenders on that charge, or on the property. So you might see, for example, let's say an RMG first and an MCAP second, right? So they're both monoline lenders in the market. And so as long as they're prime lenders, we can still combine them like a collateral transfer and bring it over as one brand new mortgage. Okay, because MCAP can also set up a line of credit, right? So we can now combine them. So as long as you got two prime lenders, you can still use this process. It's not a refinance transaction. So when I talk about collateral transfers, what I'm really trying to do, again, is to avoid going to do a refi. If you have to do a refi, that's okay. I totally get it. But, people think too, like I mentioned earlier, people say, I need more money. But ask them if they got that available room on the HELOC, right? Ask them to draw down on it instead. That way you're changing it into a collateral transfer opportunity to get insurable rates. That's basically in a nutshell what I want to let you know about. There is a handout that we have on this, so I don't know if you can pass out to the team after this. It's actually quite good. It's something that I prepared internally because I do a lot of webinars on this product. Because a lot of mortgage brokers, they think when a client says, I want to come, I need to do a refinance. Well, now you got it in your head, you're probably going to do a refinance, but ask them some more detailed questions because it might be just an opportunity to do a collateral transfer instead. Right. And clients don't know that this product is available. So, I can tell you it's probably, it is getting out there. We've been selling it a lot lately in the past year and a half because we saw rates rising and we saw this as a good opportunity for us to help mortgage brokers educate clients about the benefit of a collateral transfer. I can tell you there's no downside to this product whatsoever. You're simply combining debt like a refi. You're giving the client a lower rate, one payment. You're really, and the nice thing about this too is if some of you, and when you're talking to your clients, the client says, I want to go short term on this, right? You're able to bring in a collateral transfer using a 3-year, a 4-year, or a 5-year, or a 5-year ARM product term. So if you want to go 3 years, no problem, I can do it. It's you can transfer into that.
So that is the maximum mortgage is 25 years.
25 years. Okay.
It can be moved 30 years?
No,
No?
no,
Okay.
can't do that. That becomes uninsurable, right? Okay.
Yeah.
30 years, you're asking for uninsurable. So that changes the whole picture. Yeah, I mean, we can do it at 30-year, but the rate's going to be higher.
Higher.
Okay. Yeah, absolutely. Okay. Any questions on that, guys? No? Okay. Let me give you a couple tips on transfers as well. So we do also what's called a straight switch, where you're just basically bringing it over like as is to from another lender over to us. So that means the current lender has a standard mortgage charge registration. It's not a collateral charge registration. So those are assignable and transferable to another A lender. Those are free of charge if they're over $200,000 amount. Again, we can waive the appraisal using the impact, whatever, that kind of stuff. So if clients just simply want to transfer over, no problem. Just to let you know, sometimes when we do these transfers, right? Let's say maybe 5 years ago, they started with a bank and it was a collateral transfer. And the bank, let's say, said, they didn't quite qualify on their own because they were fairly young and maybe had very limited credit. They had to maybe get all of their down payment from family members to buy the home. So, but fast forward 5 years today, let's say that client now has got a great job, higher income, it built up some credit, and so when the first mortgage was done, the bank might have asked for mom or dad to go on the deal as a guarantor or as a borrower, right? But today, because your client qualifies on their own, we can use the collateral transfer process to remove a co-borrower or to remove a guarantor, and vice versa. If let's say now today we need actually mom or dad to go on the deal for whatever reason, I can still use the collateral transfer process to do that. Okay, because they may not qualify still. So when you remove or add a guarantor, it's free of charge. But if let's say mom or dad had to go on the deal initially with the other institution, we're bringing it over as a collateral transfer. That means FCT will charge about $850 to add or remove people from title, because it's under the land registry office. We have to deregister the charge or the title and do a brand new one. So that's the general cost. That it's actually cheaper than a lawyer, right? But FCT will charge about $850 to do that when you're removing a person from title. Okay. So that's also available here under this program. Any questions on switches? Cloud transfer? Yeah.
Is there a charge for or a penalty for a switch?
Is there a what? Sorry?
A penalty to the client for performing a switch?
Well, we don't charge a penalty, but the other lender may charge a penalty if you're breaking the mortgage midterm. Okay, so let's say if the client wants to break the mortgage early, and the bank says, well, it's going to cost you $4,000 in interest penalty, right? What you can do is you can take $3,000 of that interest penalty, you can add it on to the mortgage, And then this way, the client just has to prepare $1,000 check to FCT when they do the transfer. Okay, because they're breaking the mortgage early. But if it's at maturity, then there should be no charge. Okay. All right. Okay, so I'll stop there because I'll give you another product that I want to talk about that I think is also going to be near and dear to your hearts coming up this year, and especially for realtors. If I can tell you, I do a lot of realtor presentations on something that's called Purchase Plus Improvements. Okay, and this is a great product, especially if for you. If you have clients that are purchasing under $1 million or even over $1 million, it's available. But it is a great product that a lot of people don't know that it's available. And I'm going to ask you a question as a realtor in the question, because I ask this of realtors every time I do a webinar or do an in-person presentation on this product. The first question I usually ask realtors is, how many of you think you lost the deal because the client basically walked out the door saying to you during conversation that I don't have $30,000-$50,000 to fix up the home the way that I want to, right? So now, and I can tell you a lot of the realtors when I do this, they say about 25% of the room will usually hold up their hands. I think it's probably more realistic, around 50% of the room will probably hold up their hands. So that and the reason why I say that is because it's a lost opportunity.
Yeah.
And because maybe the client could have afforded that $30,000 or $50,000 onto their payment, but they didn't have it up front because they thought they needed to have it up front to pay to make the renovations right away. So I'll give you just an easy example of what a Purchase Plus Improvements is. So it's a product where you can basically give your client more money before the purchase transaction to close, to fix up the home the way they want. And some of the main purposes that we see are to put in a new roof, new doors, kitchens, bathrooms, finish and finished basement. So a finished basement could be for their own personal use, or it could be used to renovate the basement to do a legal basement suite to rent it out in the future, right? So a lot of people take advantage of it, and so basically what you're doing is you're taking the full cost of that work to be done, and you're adding it onto their mortgage payment, right? And so now it becomes very affordable. And I'll tell you today, if the client simply wants to do maybe a finished basement, let's say it costs $30,000, if you add that onto the mortgage, amortized over 25 years at today's rates, you're probably going to increase the payment by about $225 roughly a month. Not bad, right?
Yeah.
Yes.
So the typical scenario that I'm going to use here is, let's say if your client even has a condo, right? They want to buy a condo, and on that condo they just want to put in finished flooring, a new flooring. Let's say the kitchen and bathrooms might be in great shape, but in the condo they got old laminated flooring and they want to put it in hardwood flooring, whatever. So basically, if you think of it, you close the deal on a Friday. If you have the contractor already lined up to come in and do the work, they can, let's say, come in on Saturday morning. Maybe if it's not a big suite, maybe let's call it 900 square feet. Maybe they could probably have the new flooring installed and done by Sunday night. And then that means on Monday morning we cut a check to the contractor to pay for the flooring, right? And then we add the $30,000 onto the mortgage for the client to pay. So it's a very simplistic example. Another one could be, maybe just a brand new roof, right? Close on Friday, roofer's in Saturday morning, Sunday morning you got a brand new roof. So what we look for here is if a client is is now saying to you, yes, I want to purchase a home. They've got a firm purchase and sale agreement. And the way I would encourage you guys to do this is please do 2 submissions on a purchase plus. Okay, because the first submission, when you there probably is a condition of financing on it, and you're not going to have time to talk to your clients about going and getting a purchase plus, right? They're stressed out. They want to just purchase the property for now because they like it. And but you might have had conversations with them in beforehand where they say, yeah, I may not find the perfect house, but I want to fix something up maybe in the future when I'm okay doing that. But they don't know that this product is available, right? So when you're talking to these clients before they're actual purchasing, then you can actually now recommend it as a potential product or add-on before closing. And so when I say 2 submissions, that means that now you get them to firm up the sale, then you go back to them and say, look, I know you want to do this work. Why don't you call some contractors and get some quotes? And I can tell you that some realtors and some mortgage agents do this really well, where they've aligned themselves already with contractors that specialize in flooring, contractors or in roofing, finished basements, what have you, right? Because you've trust them, you've seen their work, you like their quality, you know them, you know that they're going to look after your client very well, right? So some of these people that have aligned themselves with these contractors is now you can give the 3 business cards to the client. Say, look, call all 3, ask them to come in, ask them to go into the home and get you quotes, and then once they go through all that process, they decide which contractor they go with. So what you do is now you submit the second submission to us as a purchase plus improvements program. And in the first submission, you should possibly write in there that I may resubmit the deal as a purchase plus, probably in about 2 or 3 weeks from now. You got to make sure that this is all done in place prior to funding. You cannot do this after funding, okay, guys? So it's really important that you now keep in contact with the client, explain the whole process of now letting them know that the work is going to get done after funding. So basically we give you about 180 days, so 6 months to get the contractors in and out to do the work, whatever it is and that's generally, lots of time. So if there's any, sometimes, let's say if there's strikes by the trades or they're having difficulty getting the materials, whatever, or the cabinetry, if there's a delay in the process, please let us know if it goes over the 180 days. Yeah.
Are there any criteria that you require when it comes to the actual improvements? Like, for example, you mentioned a new roof or flooring. What if they wanted to just buy like a new, I don't know, like an addition to the property that's not necessarily an improvement? For example, like you want to buy a piano, right? Would you guys?
No.
Like there's certain criteria, right, that you have to screen for, right? It has to be a specific capital improvement.
It has to be an improvement, like what we call a cosmetic work in the home.
Okay.
But it generally does not cover major structural changes to a home.
Okay.
So when you go to basement, so you have they don't have nothing, so you have to improve the basement, right?
Right.
Kitchen, one bedroom or bathroom, that is improvement. Just only house, not the big structure.
I see.
That's right. And then add it with a house or make another room or the bathroom or something like that.
Or for example, let's say like if they wanted to improve their hot water heating or something, like they want to do like solar panels, would that be something that they could do? Or again, that's sort of like a gray area?
Yeah, those become a little bit gray area. So any chattels, like fridge, stove, that kind of stuff, are not allowed under this program.
Got it.
Actually, with the exception of let's say if you're doing a new air conditioner or a new furnace, those can be included in this because they're going to stay stationary for a while, right? But so let's say you can do some minor structural work to a home using this program. I'll give you an example. If any of you know East York, right? In East York, there's a lot of older homes built after the war where they've got the garage attached to the home on the side, right? So what some people have done is that they've had this program where they've now removed the top wall of the home because it's a two-story home. They got the garage over to the side, and they've extended the home over the garage to build a new bedroom.
Nice.
Okay, so that's considered minor structural work because you're not tearing down a whole wall, you're just basically tearing down the top. We've also done work where we've extended the back, and put a nice sunroom. Okay, we've done that kind of work, but it's not really designed to gut out the whole home, right? So the way you identify this is the home itself has to be in move-in condition. Like, the cupboards can be 30 years old, the washrooms can be 30 years old, but they're still in useful condition, but of course they're not to the standard that the client wants. So that's why we're doing this, and that's why we call it cosmetic work, because we're now improving. Think of this maybe as your Love It and List It show. Okay,
Yeah.
this is the love it part, right? This is where you're now just renovating the inside and making it look much better, right? So that's what you're giving the money for. Okay, any questions from anybody on the screen? No, so far we're good.
So I mentioned for the old guys, if we have some deal or we can not clear about something like the home improvement, just contact the Daniel to maybe he wanna be answer to you what the question is, right? So keep in touch. That is most of the communication, then get a deal. Okay.
Yeah, like I know I only covered a couple of topics. Believe me, there's a lot of other programs available. I could be here all day. But some of the, I'll just quickly mention some of the other top programs that we do. Our BFS stated income that's available with us. We do a lot of spousal buyouts. We do assignments. We do a new to Canada program as well. So, and there's a lot of marketing things around that I can also help you with. So if any of you are interested in the actual marketing of this, right? Like, where do I go find new to Canada clients, right? I can tell you, I mean, you go down Thorncliffe Park Plaza, and my goodness, there's so many different cultures in that area around Overley and Don Mills area, if any of you know it, or the Flemington Park area. There's a lot of ethnic people that are settling in there on a short period of time, because a lot of their family members have been there, or because of the simple background culture amenities are in that area. So a lot of people tend to come there and live there maybe for a year and a half, because they're starting to get settled in Canada. They're starting to learn a new language and so forth. And then eventually, they want to buy a home. And
he has a friend is immigration lawyer.
Good, awesome. Awesome, yeah, absolutely, and yeah, I mean, and for new to Canada, you definitely want to go meet some immigration lawyers, because you can get introduced to these people as quickly as possible as they come into the country. Travel consultants as well. If you just want to, if you don't know any immigration lawyers, you know what? Go knock on them. Go knock on their doors. I guarantee you're going to help them. Same thing with family law. If any of you like family law, my goodness, I could tell you that's a big market as well. Yeah. And of course, what happens after Christmas, a lot of people tend to break up after Christmas. So we start seeing the influx of spousal buyouts right after Christmas, usually in the early spring. But I can tell you that's another big market. So go knock on some doors of family lawyers, because again, you're helping them. Right, you're going to help them find a home for one of their clients, or possibly both. Right. Maybe one of them wants to stay in the matrimonial home, so now you're helping to do what's called this equity buyout or spousal buyout, and you go up to 95% financing. So anyway, there's lots there. But they're great products. Think about what kind of business you want to build and where you want to concentrate on, because I could tell you the big ones for me. If I was in your shoes today, I would concentrate to get to know spousal buyouts really well. And there are courses you can take even as a mortgage agent that you can learn a little bit more about this. So spousal buyouts, purchase plus improvements, and collateral transfers, and new to Canada. Those four for sure are, you're gonna, like, if you can do those kind of deals in 2024, I guarantee you, you're gonna do lots of them. Those are great opportunities for you. And of course, I won't talk about any of the income stuff that we can do, but I'll mention just a couple, just so you know. So because these are things as a lender, we want to qualify your client. So let's say if you've got a client that has a car loan or some kind of loan that's going to be paid in full within 6 months of the funding date, I can remove that from the client's total debt ratio. Okay, so it helps your client qualify for a higher mortgage. So, another one that we do, I just mentioned, is we can use 100% of the Canada Child Benefit as long as the child is 14 years of age or younger, and then some of those parents are also getting what's called the Ontario Child Benefit. That we can also use 100% of it as well. Okay, so it's not all lenders offer that kind of stuff. So there's a lot of other things that but the idea is, just like saying is saying like, I want you to try to collect as much information from the client as you can when you're talking to them, right? You may not have the solution for them right then and there, but once you let them know that you're going to see what you can do about helping them the best solution, and then contact myself or any of the other BDMs that you're working with, because we know our programs and I know the type of questions that I can ask you to see if it's available that I can help you. And that's my job. My job is to help you place the deal with us, but I want to make sure that I've exhausted as many of the opportunities to help you to try to get the deal done with us. And so if you tell me they're new to Canada, well, let's say the ratios might be, 42-47. Well, a solution might be to bring in a guarantor, onto the deal, and that can save a lot of headaches. Or maybe getting a larger gifted down payment, because we accept a gifted down payment from outside of Canada. You just got to be very careful that if it's one of the restricted countries. We're probably going to ask you for a little bit more scrutiny around that kind of stuff, but I can definitely consider it. So I'm here as your support. I'm here as I'm here to actually support Sai, okay? Because Sai, I know he's a busy boy, and I'm sure there's some days where he just is so busy and may not be able to help you right then and there that second. So give me a call. I'm happy to help you as best I can with our products. Yeah.
Thanks, Colin.
Yeah. All right. You're welcome. You're welcome. My pleasure. My pleasure. So Iona's going to send out those 2 handouts to you guys. Okay. Yeah. Have that.